Anupam Guha, who's Head of Private Wealth Management at ICICI Securities, joins in with his sense of the markets. Anupam, it's great to have you on the show. Thanks very much for stopping by. How are you, selling equities in this sort of a market environment, given the current volatility as an asset class?
So, hi, morning. So, if you were to look at the numbers, right, and if you had spoken maybe 10 days back versus now, things have changed substantially.
Sure.
If you were to look at crude, it's really kind of eased out. If you look at the H1 average, it was hovering at $77, which is today at 62. So that has a big impact on, say, the overall trade deficit, fiscal numbers. If you look at currency, again, it's stabilized a bit, which is a big positive for us in the equity market. And closer, if you were to look at liquidity, which was a concern given the credit, crisis that we kind of had stared at, last month or the last 2 months. I think both the RBI and the government have engaged, and there are measures that have kind of been taken place, which really has helped the investor sentiment. In context of these two, if you were to then look at the numbers, which are typically your earnings number, I think for the last 2 quarters we've had 20% plus positive. So, for us, when we engage with our investors, we are clearly talking about, maybe given how the valuations are at 15.5 times 1 year forward, which is typically in the range of 15 to 18 long-term average. I think it clearly makes a case for equities to be looked at. So that broadly is our thought on the overall equity market.
But do you still feel, Anupam, that it's a little hazy because, while crude definitely has cooled off and that's really benefiting us, you don't know which way the global markets may be headed. Almost every night now we're seeing one of the FANG stocks take the Dow lower and its impact on the US equities per se. How best do you think can investors then cope with the volatility that we may be staring at? Because you've got the elections as well, so you don't know how the next 1 year is going to pan out, both globally as well as domestically. Big events lined up. Is there a hedge in that sense? Is there a safer way to go about investing into equities for the next 1 year?
So, Aisha, no one likes volatility, but that's the reality of life. And if that be the reality, I think for investors, they may want to see that as an opportunity. And that is our engagement with our clients. Given some of the numbers that I spoke about, so from a domestic context, the only joker in the pack is really maybe the elections, both near-term state elections and the general election that we are staring, which would need that. How do we really want to structure our entire portfolio? On the global bit, I think while there is the trade war between US and China that continues to be there, but I think people have kind of factored that in the overall valuations today where India is. Because if you were to look at the FI flows this month, both on the equity and the debt side, they are a big positive, right?
Positive, yeah.
Debt is almost close to $1 billion. Equity is $750 million. So smart money is coming into India, and that is something that I think a discerning investor is also looking at. Now, while volatility has been an issue and no one likes negative return, the only way one would want to maybe construct a portfolio is to, I think, go back to basics and go back to discipline, right? I think as markets move, so in the last 1.5 years, small and mid caps had a great rally before the corrections this year. People had over allocated to maybe an asset allocation, and hence as wealth manager, our engagement with our clients is clearly one on how do you go back to what the initial plan was and the allocation that you ideally should had, and second then is that are you really disciplined to be there. So
are you telling them to go back to large caps because that's the safer way to be, or go back to the original 2017 plan, which was mid and small caps?
So honestly, we are agnostic to any cap. We would want to look at quality, we would want to look at efficient companies, we would want to look at the earnings, we would want to look at the management. And within that space, even if you were to look at the markets, even while Nifty headline numbers look good vis-a-vis other small and mid cap, we all know that there were only a few set of stocks that were really pulling the index there up as well. So within large caps, you've had laggards and you've had winners, and likewise is the case across the market cap. Having said that, liquidity is an issue, and which is why I think clients are looking at, or investors are looking at, moving more towards a slightly larger name, because the bounce back seems to be better there, given that corrections have already happened. So I think there is a bit of a bias to a larger mid cap or a large cap, but I think from a investment philosophy, we continue to be agnostic to that.
Okay, but what would be your ideal asset allocation, especially allocation to debt?
Right. You know, when Aisha spoke about volatility, in fact, the first thing that came to my mind is really the volatility in the debt market, right?
Yeah.
And for investors who generally look at investing and parking their money in debt, which is typically your, you know, safer asset, people do not like, you know, drawdowns or negative returns there. And that's what really happened in the last, you know, few months, wherein even in liquid funds we've had negative return.
Yeah.
So on the debt allocation per se, if you were to look at the shorter end of the curve, which is typically driven by liquidity and you know, government policies, RBI has stated a calibrated tightening policy, right? You also have liquidity, especially with Q4 coming in. There is an overall you know, liquidity tightness in the market. Given that, we feel that even at the shorter end, one may not want to get into any mark-to-market you know, investments where there could be a mark-to-market volatility, so to say, and hence we think carry is you know, or an accrual is a strategy, and hence liquid or an arbitrage in the shorter term looks good. Yields are heightened. Now, in a heightened yield, for somebody who would want to lock in their yield on the debt side, FMPs or corporate bonds are something that investors are finding favor in, and that is how the entire allocation is getting constructed on the debt side.
You know, the other day, just floating around from all of our RMs across banks, and they're now really pushing fixed deposits higher because they're saying earn 7.5% now, 8% next year. Is fixed deposit really where we're heading into? Would it be safe to park your money for the next 1 to 2 years in FDs or liquid funds? It is.
No, it has to be a basket again. Like a tax free available at 6.5 is a great opportunity. Just think about it, tax free at 6.5 versus a fixed deposit at 7.5 that you're speaking about. Then in that context, maybe a 6.5 tax free, but tax free is typically for long term, you know, because you again do not want to look at a mark to market. For shorter term, you have multiple you know, avenues of investment, including a fixed deposit, and the investor you know, the investor class is also fairly varied. You know, you have some experienced investors, some new investors, and hence I think one will have to kind of have a bouquet of product and opportunities for one to choose.
Okay, so very quickly construct an ideal portfolio for us in terms of asset allocation across you know, asset classes, both for a conservative as well as aggressive investor for the next 1 year. I know I'm putting you in a spot here.
Yeah, so 1 year is a tricky bit, given that we have elections. So so if one were to give 100 rupees now, even if you're an aggressive investor with a 1 year view, you really can't give an equity allocation, unfortunately. And hence one will have to then construct it in a manner. But again, I'm saying, you know, from your context, one will have to see whether it's an existing ongoing portfolio and then you're doing a rebalancing, or it's fresh pool of money. What we are telling our investors is essentially, if you have money to allocate on the equity. So our typical asset allocation is 70-30 in favor of, if it's a conservative client, it is 70 on debt and 30 on equity. And within that, you may have an allocation to gold, or you may have an allocation to alternate. And likewise for equity, wherein the 70 or 70 to 80 goes into, for an aggressive investor, into equities. For new allocation to equity, we are telling our clients that, listen, you may want to, given how the valuations are, and we feel that the numbers that I spoke about, the numbers look good. One may want to put 40% of your money today in equity in lump sum, and you may want to go back to discipline, as I spoke about. So you stagger, because you do not know how, say, the December results are going to be on the state side, or vice versa. And hence you may want to just stagger the investment. So say a 30% allocation that you stagger, and the balance 30 you keep close to yourself, because there are event risk and you may just want to, you know, deploy it then as an opportune moment.
Okay, great having you on the show, Anupam. Thanks so much for taking the time out and speaking with us.
Thank you so much.
Okay, that's the word coming in on how best investors, both conservative as well as aggressive, can look at treating their portfolios right now, and what is the ideal asset allocation.